Imagine a world where the ticking clock doesn't control you, where every second doesn't slip away as just another penny earned. What if, instead of you working tirelessly for every dollar, your money was the one clocking in? Dive with us into the captivating world of passive income, where your wealth grows while you sleep, where you're free on a sunlit beach, or even right now as you watch this YouTube video. The secret? It's not about working more, it's about making your money work smarter. Once you begin investing for passive income, it can become addictive. You might start with just a small amount of extra money each year, but soon you might aim to earn more money every month, week, or even daily. Many believe that you need a substantial amount of money to start generating passive income, but that's a misconception. While having more capital is beneficial, you can start with as little as $1,000. In this video, we'll explore how compound interest can help you generate passive income with such an amount. Compound interest is a financial concept that might seem like magic, but it's based on a simple idea: making your money work for you and grow over time. Imagine you invest some money today, and it starts earning interest. The exciting part is that the interest it earns doesn't just sit there, it goes to work, generating even more interest. It's like your money having babies, and those baby dollars grow up to have more babies of their own. This cycle continues, and that's what creates the magic of compounding.
The biggest thing in making money is time, and I've had this long run, and so the compounding at the end turns into very big numbers. But you've got a tailwind in this country if you just own a cross-section of it. One big thing is keeping down expenses, and the other thing is not trying to pick one stock, but owning a large group of stocks and buying it over time, and then just sitting and paying no attention to people who say they know when to buy and sell stocks or buy and sell this individual stock. So it's a very simple game where the person who doesn't try to do very much usually does better than the person who spends a lot more energy on it.
Even if you're not investing money in the traditional sense, you're still compounding something valuable: knowledge and skills. When you go to work every day, you're building on your expertise, which makes you more valuable as time goes on. As with money, this can result in higher pay as you gain more experience. Now, let's talk about money itself. Money doesn't gain skills, but it gains power. A $100 bill doesn't have any more abilities than a $20 bill. It simply has more purchasing power. With that purchasing power, you can buy more money-making tools or assets, like machines or investments, that will generate more income for you. The real magic happens when every dollar you earn can buy even more money-making assets. For example, a $20 bill can buy 20 machines, while a $100 bill can buy 100. This means more money equals more potential for making money. Warren Buffett once said compound interest was a key factor in his wealth. He referred to it as a perpetual money-making machine, because your initial dollar works hard to earn you more dollars, and the cycle continues. Each time your money multiplies, you can acquire more money-making assets, further increasing your wealth. You don't need a fortune to get started. Even a small amount can grow significantly over time. The longer you let your money compound, the more it multiplies. It's like a snowball rolling downhill, gaining momentum and size as it goes.
It's like Charlie always describes compound interest as being like, being at the top of a very large hill with wet snow and starting with a snowball and getting it rolling downhill. And that's a little bit like the acquisition situation works. We've been by being around 38 years, it's been a high mountain in terms of the length the snowball is going. By now it's going at a pretty good clip, and it's pretty good size, and it tracks a lot of snow.
While doubling your money daily might not be realistic, it demonstrates the incredible power of compounding. There are various strategies, both active and passive, to make your money grow over time. Actively compounding your money is like planting seeds to grow a money tree. Imagine you start with $1,000. You don't just spend it, you invest it smartly. This means you might buy something valuable, like a house for $100,000. Make it even better, and then sell it for $150,000. Instead of pocketing that $50,000 profit, you take it and buy an even fancier house for $150,000. By doing this, you're not spending your profits on vacations or gadgets. You're reinvesting them to buy better and more valuable assets. It's like trading up in a video game to get better gear. As you keep doing this, your money keeps growing because you're dealing with bigger and more valuable things each time. Think of it as a snowball rolling down a hill, getting bigger and faster as it goes. So, your $1,000 might turn into $2,000, and then $4,000, and it keeps doubling. But here's the catch. You can't take too much money out for yourself because it slows down that snowball. If you keep taking money out, it's like scooping some snow off the snowball, and it won't get as big. However, there's a risk involved. If you put all your money into this snowball and something goes wrong, like a bad investment, you could lose everything. So it's like a game where you must find the right balance. Take some profits for yourself to enjoy, but also put enough back into the snowball to keep it growing. This strategy worked for Warren Buffett. When he made a lot of money, he didn't buy fancy cars or mansions right away. He poured most of it right back into his big dreams to make them even bigger. He believed in growing his projects first and enjoying the rewards later. So, actively compounding your money is like planting and watching seeds turn into a forest. Just be careful not to cut down all the trees before the forest is mature, or you might just end up with nothing. The second way to grow your money is through passive investing. This means putting your money into things like the stock market and letting it grow over time without actively managing it day to day. When your investments in these assets generate profits, you reinvest those earnings, and this process turbocharges your wealth accumulation. Now, when we talk about traditional bank savings accounts or certificates of deposit, CDs, they usually offer very modest returns, often around a paltry 0.1% to 1%. To put it into perspective, at such sluggish growth rates, it would take an astonishing long 72 years to double your initial investment. Clearly, this isn't a speedy way to build substantial wealth within your lifetime. To supercharge the growth of your wealth, consider investing in assets such as stocks. By buying shares in companies you have confidence in, you position yourself to benefit from their expansion and increased profitability over time.
You can rearrange your business empire, which you own through that little portfolio that you have. You can rearrange that, at a moment's notice with practically no cost. It's a huge advantage, which people turn into a disadvantage. There is nothing about the price action of the stock that tells you whether you should keep owning it. What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning stocks.
This growth manifests in the form of rising stock prices, which directly increase the value of your investments. The beauty of this passive approach is that there's no fixed timetable for how quickly your money can grow in the stock market. Your returns depend on various factors, including your investment choices and market conditions, making it a flexible strategy. On the other hand, active methods, like launching a business or engaging in flipping ventures, can potentially offer rapid and substantial returns. It's not out of the question to see your money double or more in just a year. However, it's essential to note that these outcomes are far from guaranteed and hinge on your specific enterprise and your skills as an entrepreneur. In contrast, the stock market provides a more reliable path to compound your money over time. While it still has some variability, it offers a proven way to grow your wealth steadily, because it has gone up by 8 to 10% a year historically. So, even if you stay on the low end here, 8%, you're going to be able to grow your money much faster. The stock market is like a place where people buy and sell pieces of companies. When you invest in the stock market, there are two main ways you can make money. First, there's something called appreciation. This happens when the price of the piece of the company you bought goes up. It's like buying something at one price and selling it later at a higher price. Second, there are dividends.
If I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children had grown, the house was paid off and everything. I wouldn't worry too much about having a lot of cash.
This is when the company you invested in gives you money regularly, like a cash gift. It's like getting a paycheck from your investment. If your money grows at an 8% annual rate in the stock market, it will roughly double in approximately 9 years, echoing Warren Buffett's advice that if you can't commit to owning a stock for a decade, you shouldn't even consider it for 10 minutes. That's pretty good. It's much better than the old way of thinking, which said it would take 72 years. Now, the snowball effect happens when you get dividends and use that money to buy more pieces of the company. This means you own even more of the company and you can get more dividends. It keeps going in a cycle and your money grows faster. But not every company gives out dividends. Only the big, well-established ones usually do. They have so much extra money that they share it with their investors. They do this because they don't have any big plans to use that money to make the company bigger right away. However, there are other companies, like startups or ones focused on growing, that don't give out dividends. Instead, they take the extra money they make and put it back into their company to make it bigger and better. They might not show big profits on paper, but they can have a lot of potential in the long run. For example, back when Amazon was just starting out, they didn't make much money when they first became a publicly traded company. Instead of making profits, they put all the money they earned back into growing the company. So, if you invested in Amazon during those early days, your money was like a seed that kept growing. However, investing in a company like this was risky because startups sometimes fail. That's the reason why Warren said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. On the other hand, there's a different type of investment where you buy shares in the companies that pay you a portion of their profits regularly. These companies are usually bigger and safer, but the returns are smaller. Typically, they're around 2 to 4%. The downside is that you have to pay taxes on the money you get from these companies, even if you reinvest it. Another way to make your money grow is by investing in real estate, like houses or apartments. It's a favorite for many because you can earn money from renting the property and also from the property's value going up over time. If you invest $100,000 in a property and get a 7% return, that's like getting $7,000 every year. After 10 years, you could use that money to buy more properties or add it to your investment. Investing in real estate is a unique way to build wealth, driven by two main advantages: cash flow and property appreciation.
They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation. That's one reason real estate in general is good during inflation. If you built your own house 55 years ago like Charlie did, or bought one 55 years ago like I did, it's a one-time outlay.
Imagine you buy a property for $100,000. This property can give you $7,000 in income each year without you doing much. Plus, over time, the property's value could increase, maybe even reaching $200,000. Here's where it gets interesting. You can use a clever move called a 1031 exchange. This means you sell your property for $200,000 and you buy another one of equal or higher value. The best part is that you can avoid paying taxes on the profit from selling the first property. This is not like stocks, where you have to pay taxes on your gains before reinvesting. Real estate also comes with tax benefits. Even though you're making $7,000 a year, you won't have to pay taxes on all of it. Real estate has different tax deductions, like one for property depreciation, which means that you get tax benefits as your property gets older. But real estate isn't all roses. Unlike stocks, it's more complicated because you deal with many people: real estate agents, property managers, contractors, lawyers, and tenants. You're also responsible for making sure the property makes money, and if things go wrong, you might need to sort out problems or pay for repairs. One big difference from stocks is that real estate needs a lot more money up front. You can buy stocks with as little as $100, but a property requires a much bigger investment. No matter if you choose real estate or stocks, the main idea is the same. Let your money grow by reinvesting your earnings. That's the secret to building serious wealth. But remember, all investments come with risks. It's super important to do your research. Think about your money goals, how much risk you can handle, and how long you plan to invest before you jump in. When it comes to finding good real estate deals, there are lots of strategies. One is to look for sellers who are eager to sell because they want to avoid paying high fees. Many pros specialize in finding these kind of deals. In the world of investing, knowledge is power, and making smart choices can make a big difference in how much money you make.